Hello, everyone. This is Dr. Zaidi. In this video, I'll be discussing the difference between actual and applied overhead. Okay, so before we start our discussion, you need to understand the manufacturing overhead T account. So as you can see here, the left-hand side of the manufacturing overhead, which is a debit side, shows actual, right? What does it mean? It means the actual overhead that you incur during the period will be mentioned here on the actual side. Whereas the right-hand side of the manufacturing overhead is applied overhead. So when you're going to apply overhead, when you finish a product and you're ready to apply overhead, that's where you're going to apply on the right-hand side or the credit side of the manufacturing overhead. Okay. So when you calculate a product cost or manufacturing cost, there are three items that you need. First, direct material. Second, direct labor. And third, manufacturing overhead. And we are talking about the manufacturing businesses, okay? Because in service industry, you may not have direct material. So manufacturing cost includes direct material, direct labor, and manufacturing overhead. As you can see, two of the items shows direct material and direct labor. So the direct cost of a product cost includes direct material and direct labor. Direct material and direct labor are the costs that can easily be traceable to a particular product, is cost effective to trace. It's a significant portion of the product. So that's direct material, or someone who is directly working on making the product, that's direct labor. All the indirect costs related to the factory building or manufacturing building goes into manufacturing overhead account. So manufacturing overhead includes indirect costs. What are the indirect costs? Indirect material, indirect labor, other manufacturing overhead. So as you can see that when you incur the indirect material cost during the period, you're going to put it on the actual side of the MOH account. When you're going to incur the indirect labor, you're going to put it on the left-hand side. And other manufacturing overhead includes depreciation on the factory building, utilities on the factory building, and the real estate taxes, and some other items that are not direct material or direct labor, or they are not indirect material or indirect labor, are going to end up in the other manufacturing overhead account. So this is the actual side. The left-hand side is the actual side of the MOH account, right? Now, how do you know which one to use, which MOH to use? Should you use actual manufacturing overhead when you calculate the product cost, or should you apply overhead and use the applied overhead cost? Well, in reality, firms use applied overhead. Now, the question arises, why companies use applied overhead? All right, there are two reasons. One of the main reasons that companies use applied overhead cost is because there are seasonal fluctuations. The cost of utilities, for example, are not uniform. As you can see here in this table, it shows in this graph, it shows that during the month of January, your utility cost is lower. And as you move towards summer months, it shows May, June, July, your utility bill is high. So what does that mean? Means maybe you consume a lot of electricity. The air conditioning cost may drive utility bills higher during the summer, which can affect your manufacturing overhead. So that means that you're not going to have uniform manufacturing overhead during the, throughout the year. If you don't have uniform MOH throughout the year, then, during summer months, your product cost may be higher, and during winter months, your product cost may be lower, as MOH is a part of your manufacturing cost. So in order to smooth out those fluctuations you have, what companies do is company calculate the overhead rate, which is known as a predetermined overhead rate. And using that rate, they apply overhead whenever they need it, right? So they calculate overhead rate at the beginning of the period. So they can if they need information during the month of June or March, they can use that rate to apply overhead. The second reason is that the actual overhead information is not readily available. So for example, if you need a product cost information in the middle of the June, right? June 15th, you completed the product and you need the total cost. You may have a direct material information available. You may have a direct labor information available, some indirect material, indirect labor, but you may not have utilities information available during the middle of the month. So either you have to wait until the end of the month or whenever your utility bill arrives, then you can calculate the overhead cost. So for that particular reason also, companies use predetermined overhead rate and apply that to calculate the manufacturing overhead. So they can use it at any given point in time whenever they need that information. All right, so now what we're going to do is we are going to post some entries here in the manufacturing overhead account. So you know that how the actual manufacturing overhead is incurred and how we apply manufacturing overhead. So our first general entry is Z Corporation issues 20,000 of indirect materials to production. So 20,000 direct material of amount, $20,000 of indirect material is issued to production means the material is moving from your raw material inventory department to your MOH account. Because it's an indirect material, it moves to MOH account. So which means that you're going to credit raw material inventory by $20,000 because it's moving out. It's an inventory account. It's a decrease in assets. So you're crediting it. Decrease in assets are credited. So an MOH is debit because it is moving to MOH account. Now, if it's a direct material, it would move to work in process account. All right. It's because it's an indirect material and we are discussing only MOH. So this is going to move to your MOH account as the actual MOH incurred during the period. So you see here 1, and this is a reference number 1 here, $20,000 actual. All right. The next is Z Corporation paid $40,000 to factory security guard. Now, factory security guard is an indirect labor. Okay. So when indirect labor you incur, then again, you're going to debit MOH. So MOH is debited by $40,000. And because Z Corporation already paid $40,000, so cash is credited. If the entry would say that Z Corporation incurred $40,000 in the factory security guard salary cost, then it is possible that they have to pay it in future. So you could put accounts payable. But in this case, they already paid. So you credit cash. Cash is decreasing because it's an asset. Asset is decreasing. You are paying to the security guard. And security guard of the factory building is the MOH, right? Is a manufacturing overhead. So you're going to debit MOH by 40,000. So now these two entries, the first one is indirect material. The second one is indirect labor. Now, the third one, we're going to start with the other factory overhead. The other factory overhead, in this case, Z Corporation received $5,000 bill for factory utilities. Now they received a bill. That means that they have not paid it yet. If they say Z Corporation has paid $5,000 bill of utility bills, the entry might be different. So in this case, again, MOH is debit because they incurred $5,000 in utilities cost, but they haven't paid it. They received the bill, but they haven't paid. So utilities payable is $5,000. That's a liability account. When liability increases, you credit. So the liability is increasing. You're crediting utilities payable and you're debiting MOH by $5,000. So your other factory overhead amounted to $5,000 here in your entry number 3. Move on to entry number 4, depreciation on factory building recorded for the year 50,000. Again, that's also an example of the other factory overhead. Now, in this case, it says that depreciation on the factory building recorded for the year $50,000. So what do you debit again? You debit MOH and you credit accumulated depreciation by $50,000. All right. So entry number 4, again, you debit $50,000 because it's an actual MOH you incur during the period, and then you're crediting accumulated depreciation. Now, I am not showing all the T accounts. I'm only showing you here manufacturing overhead account. So you understand that when you have a raw material T account, you're going to credit by 20,000. If you have a cash T account, you're going to credit by 40,000, and so on and so forth. But here we are only discussing MOH. So I'm only showing you how to record it in the manufacturing overhead account. All right, next entry is related to the applied overhead. Okay, Z Corporation applies overhead using direct labor hours. The company estimated $100,000 of the total manufacturing overhead cost for an estimated activity level of 10,000 direct labor hours. During the year, company used 11,000 direct labor hours. So if you look at this question here, the company estimated means what? Budgeted, right? When do you budget? You budget at the beginning of the period, right? Probably beginning of the year, beginning of the month. But in this case, because it's a MOH, you have to avoid seasonal fluctuation. You are going to estimate at the beginning of the year. So the company is estimating that they are going to incur $100,000 cost in MOH, and they are also estimating that during the period they are going to use $10,000 of direct labor hours. All right, and they apply overhead based on direct labor hours. Okay, but in actual, company incurred 11,000 direct labor hours. They used more direct labor hours that they have budgeted. So let's calculate the applied overhead based on that. So in order to calculate applied overhead, so here is the formula. The applied overhead, you have to calculate by multiplying POHR. POHR is predetermined overhead rate. Predetermined overhead rate times the actual allocation base. Actual allocation base is what? The allocation base is a cost driver, whatever is driving the cost. So for example, if you drive a car, what drives your cost? Number of miles driven drives your cost. The more miles you drive, the more gasoline you're going to consume, and therefore the more is going to cost you, right? Electricity cost, can be determined by number of kilowatts usage. The more kilowatts you use, the more is going to be your electricity cost. So that's the cost driver. In this case, the cost driver is direct labor hours, right? So allocation base is direct labor hours. So allocation base has various names. You can call it allocation base, you can call it allocation driver, you can call it resource base, you can call it resource driver, you can call it activity base, you can call it activity driver, you can call it cost base, you can call it cost driver, right? A lot of books use cost driver or allocation base or resource based as well. Okay, but you have to understand that the concept is same. It's just the different terms that has been used for allocation basis. Okay, so two things you need. You need for applied overhead, you need actual allocation base, and allocation base in this case is direct labor hours. The actual direct labor hours are provided. What is that? During the year, the company used 11,000 direct labor hours. So that information is provided. However, the rate is not provided, predetermined overhead rate. So in order to calculate predetermined overhead rate, you have to use another formula. To calculate the predetermined overhead rate, if it's not given, you have to divide estimated overhead by estimated allocation base. Okay, so in this case, estimated overhead is provided $100,000. Okay, and the estimated activity base or allocation base is 10,000 direct labor hours. So estimated is same thing as budgeted, what you have budgeted at the beginning of the year. Budgeted overhead divided by budgeted allocation base or budgeted cost driver. So if predetermined overhead rate is not provided, you have to use this formula. So let's use this formula to calculate our predetermined overhead rate. As I stated that $100,000 of estimated overhead is provided, and then the resource base or allocation base is 10,000 direct labor hours. Okay, these are budgeted hours. So divide 100,000 by 10,000, you get $10 per direct labor hours. So now you got a rate, POHR, $10. The actual allocation base is already provided. How much is that? How many hours? 11,000, right? So what you do is you use that $10 per direct labor hours, and you're going to multiply this with the actual allocation base, which is 11,000. This will give you 110,000 of applied overhead. This is what you have got so far, 110,000 applied overhead. This goes to your MOH account, right? So T account, again, because the applied overhead is on the right-hand side, and so you are applying on the right-hand side. You're inserting that value, 110,000 that you have calculated here, right here, and that belongs to reference number 5, entry number 5 here. So that's applied overhead. So now you have a left-hand side is the actual overhead and right-hand side is the applied overhead. Now at the end of the period, you have to calculate the balances in each account. So whether it's a work in process account, finished goods account, manufacturing overhead account, or any account. So now you calculate the balance of MOH account for this purpose. So what you do is you add all the left-hand side here, actual 20,000, 40,000, 5,000, 50,000. You add them together. This gives you 115,000. And then you add the applied overhead on the right-hand side. If there are multiple applied overhead, you add multiple. In this case, you have one, so you're just putting 110,000 here. So your left-hand side is 115,000, your actual. You're applying 110,000, which means that you applied less than what you have actually incurred, right? You applied 110,000, but you incurred more. So what happened? If you balance it out, you subtract 115,000, you subtract 110,000 from 115,000, you get 5,000 balance. Okay, you get 5,000 balance because you applied 5,000 lower than what it should have been. All right, so you have a debit balance. When you have a debit balance on MOH account, it means that you have under applied. And you can see here 115,000 and 110,000. That means that it's lower than 115,000. So you have under applied. If it was over than 115,000, you would have over applied. But in this case, you have a debit balance and you have under applied. Okay. So what do we do when this happens? When you have over applied or under applied, your cost is not accurate. Remember that cost includes three things: direct material, direct labor, and manufacturing overhead. If your manufacturing overhead is understated, if it's under applied, that means it's understated. If it's understated, your cost of goods sold is understated. If your cost of goods sold is understated, your operating income is inflated or overstated, right? So in order to fix that problem, you need to adjust or close the over-applied or under-applied overhead in MOH account. So in order to close that or dispose of the under-applied or over-applied overhead, there are three methods that are usually used for disposing of to over-applied or under-applied overhead. One of the methods known as adjusted allocation rate approach. We are not going to discuss each of the methods here. There is a separate video for that where I'm going to discuss that. You can review that video. The other approach is the proration approach. Again, we're going to discuss this in a separate video, how to use proration approach. And the third method is the write-off to cost of goods sold approach. Very simple approach. Again, we are not going to discuss this. But just to let you know that there are three methods to dispose of under-applied or over-applied overhead. And that will take care of all the problems in your cost of goods sold as well as your operating income, and it fixes the problem. And thank you for watching my video. If you need live updates, you can please subscribe my channel.